Welcome back, everybody, to Volatility Trading Strategies. So hopefully you've had a chance to check out part 1 of this VXX UVXY series that I'm making. If you haven't, I'll leave a link up here. You can check it out later. In that first video, I showed the insane decay path of these long volatility ETPs over time, which hopefully illustrates pretty clearly why being on the long volatility side of things is a very low probability trade. The fact is, they do spend the majority of their time going down, so making money buying them is very hit and miss. Now, there are market conditions where going long volatility makes some sense, which I'll talk about in this video, but in order to put the odds in your favor, you really do have to understand how the products actually work. So that's what part 2 is about today. If you're going to be trading volatility ETPs, it really is in your best interest to understand exactly how they work and what causes their price movements. So subscribe to the channel, of course, smash the like button for me, and let's get into how they actually work. So this video may be a little bit technical, but I do want to encourage you to watch it to the end. And hopefully this is the only video of this type that you ever have to watch again. So give me 10 minutes. Trust me, this stuff is important. So first things first, volatility ETPs don't derive their price based on supply and demand. The day-to-day volume, the buying and selling of VXX and UVXY doesn't change their price. I know it sounds strange to hear that, but volatility ETPs are not like any other stock or index on the market. And it all starts here. This is the SP VIX STR index, the S&P 500 VIX short-term futures index. If we scroll down to the description, the S&P 500 VIX Short-Term Futures Index utilizes prices of the next 2 near-term VIX futures contracts to replicate a position that rolls the nearest month VIX futures to the next month on a daily basis in equal fractional amounts. This results in a constant 1-month rolling long position in first and second month VIX futures contracts. This index is what nearly all of the volatility ETPs are based on. So VXX, UVXY, SVXY, VIXY, the old TVIX before it was delisted, the old XIV before that one was delisted. All of them are based on this underlying index. All the volatility ETPs track this index with various leverage factors. So this is a chart of that SP VIX STR index, exactly like the one from the website. And this is the long volatility ETP called VXX. This is the original one that launched in January 2009. It has no leverage, so it's virtually identical to the SP VIX STR index. That is, of course, by design. It's the exact same methodology of holding a combination of first and second month VIX futures contracts. I'll get into that shortly. And here's that same index compared to the UVXY. Now, the only difference here is the UVXY is a 1.5 times leveraged volatility ETP. So it does track the SP VIX STR index with the exact same methodology, but it does so with a 1.5 times leverage factor. That's the only difference. Now, at some point, you've probably seen this website. If you haven't, you can bookmark it. It's VIXCentral.com. This chart here is called the VIX Futures Term Structure. Now again, please give me a couple minutes here because this is super important. Each one of these dots represents a different VIX futures contract that is expiring in a different month. So this first one, we sometimes call it M1. You might also hear it VX1. It's referred to differently, but it represents the first month VIX futures contract. This one expires in January. This one, M2 or VX2, that's the second month VIX futures contract expiring in February. Then March, April, all the way out to August. Now remember that SP VIX STR index and VXX and UVXY are only based on the front 2-month VIX futures. None of the other futures have any effect whatsoever, so at least until the next monthly expiry, we can completely ignore all the other ones. Now remember that SP VIX STR index rolls the nearest month contract to the next month in equal fractional amounts. This results in a constant 1-month rolling long position in first and second month VIX futures contracts. I call this constant future VX30. Remember that, the VX30. That's the constant 1-month VIX future made up of the front 2 contracts. So the best way to explain this is to check out the last full expiration cycle from the previous month, which began on November 18th, 2020. So we can go to the historical pricing, 2020, go to November 18th. And unless there are any holidays in the next month, that's always on the 3rd Wednesday of every month. So how this works is, on the first day of the new cycle, like we see here, November 18th, 2020, the volatility ETPs are 100% representing this front month M1 contract and 0% of this back month M2 contract. That means that the constant maturity VX30 contract is exactly the same as this front month M1 future. On the first day, M1 equals VX30. Now, if we click forward one day, a small amount of that front month representation is shifted towards the back month. And now that VX30 contract is moving slightly forward of the M1. It's only one day, it's just a little bit, but that rolling 1 month contract is now using a little bit of that M2. Now, if we click forward to mid-cycle, say December 2nd here, now the rolling 1 month contract, VX30, is roughly half of the front month M1 and half of the back month M2. So it's representing both, and it's right there in the middle. And if we click forward to the last day right before expiration on December 15th, we now have the VX30 being nearly all of the back month M2 contract and only a very slight amount left in the front month M1 contract. This means when I do tick over one more day, this M1 contract will disappear, and the M2 contract will become the new M1 contract for the next cycle. The old M3 contract, which up until now was completely irrelevant, now that M3 becomes the new M2 in the new cycle. So let's click it, and there it is. A new cycle begins, and that rolling 1 month VX30 is once again 100% on the front month M1 and 0% on the back month M2. And the whole process starts over again for another month. Each day we tick forward, a little bit of the focus on the M1 will be shifted towards the back month M2. That process is absolutely vital in understanding volatility ETPs, because once you understand that first part, how the VX30 cycles through and represents changing amounts of the front 2 month VIX futures, now we can add the second piece of vital information. So if we go back one day before it expired, remember the VX30 is all the way up here, nearly all the second month future. But the VIX index itself on this day was 2289 right there, basically identical to the soon to expire M1 future. That's not a coincidence. All of these VIX futures are free to move around. VIX futures are a freely traded market, so they can deviate substantially from the VIX index. However, at expiration, every single monthly cycle, no matter what, the front month M1 VIX future will be identical to the VIX index. For just that moment in expiration, M1 and the VIX index are the same value. So if we click back to that middle value again on the 2nd of December, we can see this relationship between M1 and the VIX. But the front month M1 future is here, back month M2 is right here, and that rolling 1 month VX30 is right there in the middle. So that difference between the VX30 contract and the VIX index, that's called roll yield. So pay attention now. I've been setting this up for a few minutes, but here comes the punchline, I promise. This roll yield, the gap between VX30 and the VIX index, is what you could consider the potential decay for the volatility ETPs. We can mathematically represent how much potential decay there is at any given time based on the ratio of these two data points, VX30 to the VIX. This is called the VX30 to VIX roll yield. So looking at these numbers on this day, December 2nd, 2020, VX30 was 2346, and the VIX index was 2117. That means the VX30 to VIX roll yield on this day is 10.8%. That number is positive, meaning there is a headwind for the volatility ETPs. Now again, VIX futures are free to move around day to day, and anything can happen on any given day. There's no guarantees at all with roll yield. Things can change in a hurry. But if that VX30 to VIX roll yield is a positive number, it means that all other things held constant, if the market just plugs along the way it is, the long volatility ETPs will decay. VXX and UVXY, they will be going down. Again, it's not guaranteed, markets can change on a dime, but it's about potential. And the higher that roll yield, the more potential there is for decay. Now on the flip side, if that VX30 to VIX roll yield is a negative number, it means that all things held constant, if the current market action persists, that's a tailwind for long volatility ETPs. Mathematically, VXX and UVXY could be pushed upwards and actually increase in value. You see how that works? These products are entirely based on the changing values of the VIX futures that they hold, not supply and demand. That SP-VIX STR index is 100% based on the futures it holds and how those converge to the spot VIX at expiration. So if a trader wants to have the highest probability of success, it does stand to reason that they would want to align their trade, at least on the surface, with the mathematical tailwind or headwind in the VIX futures. So how often are they positive and how often are they negative? This is the VX30 to VIX roll yield since the inception of VIX futures in March 2004. And as you can see here, they do spend the majority of their time in that positive range, and not all that often in the negative range. In fact, if we dig a little deeper into the statistics, we can see that the rolling percent of days with positive roll yield is 81.77%. So about 82% of the time, the roll yield is positive, meaning a headwind for the long volatility ETPs. 82% of the time, anybody holding VXX or UVXY will likely be quite disappointed while they watch it bleed down. And the long-term median is 8.24% roll yield, which is a very healthy amount of potential decay. So if we couple those two facts, first of all, that the volatility ETPs do tend to decay when the VX30 to VIX roll yield is positive, and secondly, that the VX30 to VIX roll yield is positive on roughly 82% of trading days with an average amount of 8.24%, that's how we get this. The SP VIX STR index since 2004 and all the other long volatility ETPs mirroring this, having tremendous persistence to head towards zero. For anyone who wants to buy long volatility ETPs, maybe anticipating a market crash or something, I hope you realize how notoriously difficult a trade that is to profit from. The pure math of it is not on your side. Now, there is hope for those who can't help themselves because that does leave 18% of the time where the roll yield is negative. Now, I'm not saying that's a good time to buy volatility either. It's a very difficult trade. At least here, you'd have the tailwind of the roll yield helping you out a little bit. If you do get the timing a little bit wrong, it's not completely punishing because you do have that roll yield assistance. So all of that is another reason, part 2 here, why you may not want to be buying VXX or UVXY, at least not when there's a mathematical headwind against you. I am sorry it was so technical, but everything with volatility ETPs does come down to those futures. And if you don't understand that process, you're essentially running in the dark, blindfolded, with your shoelaces tied. Probably not going to work out very well for you. So if you want to see how the VTS community uses information like this to turn very risky products with huge drawdowns into tradable assets, you can claim your free trial on my website and check out some of our live trades. See you next time. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.